Most YouTube videos these days interpret the market focusing on chart candles like SMC or ICT. The concept itself might seem logical, but it wasn't very effective for me, at least. My account showed some growth at first, but I soon started losing most of my investment capital. I was busy looking for new investment methods every time, and my account status just got worse from there. I'll go into more detail about this part in just a little bit. To grow an account successfully, entry and exit strategies are important, but the key is risk management. Even if you've grown your account with many small wins, one bad trade can make it all disappear. Always make an exit plan before entering and learn to accept a certain amount of loss. I've also held on to losing positions with a whatever attitude, despite bad habits causing big losses. Failing to take one small loss led to liquidation, and all my previous profits just vanished. Reckless risk management like this almost always ends in total liquidation. The only way to prevent this is to set stop loss and take profit plans before you even enter a trade. Once you have a plan, you must stick to it with discipline and never change it. In trading, your top priority should be focusing on how to survive rather than how much you can make. Here are the rules that I personally use. The loss from a single trade should never exceed 2% of your total investment capital. For example, with $10,000 in assets, a single stop loss should be $200 at most. The most important thing is to focus as much as possible on protecting your principal. The amount you invest in a single trade should not exceed 20% of your total assets. Major stocks have low volatility, so a 5% stop loss allows a 40% allocation, but crypto is highly volatile, requiring a wider stop loss. So you must be ready for a 10% loss and only invest 20% to minimize the damage. By minimizing losses this way, even after 10 straight losses, you'll have over 80% left to recover. Next, let's talk about setting up your trading environment. Protecting capital with stop losses is key, but you also need to cut down on fixed costs like fees. Some beginners ignore or don't even know about fees, but they can deal a fatal blow to your account over time. Let me give you a quick example of how this works. Now, let's say you enter a position with $10,000 using 10 times leverage. Right after entering, fees are deducted from your P&L, putting you in the negative immediately. And it doesn't stop there. You also have to pay fees when you close out your position. So you pay a fee to open the position and another one when you take profit or hit your stop loss. Since I pay it twice for a round trip, the total fee I have to pay is $10. I need to make a profit of over $10 per trade, and if I hit a stop loss, the damage accumulates including the fees. As trades repeat, fees keep piling up, so you must reduce them as much as possible. I'm using a platform called Bybit where you can access various futures trading, including Bitcoin and altcoins, as well as stocks, forex, energy, and commodity futures. I've tried various crypto exchanges, but I haven't seen one with as much versatility as this one yet. Since the fees are also quite low, I recommend trading here whenever possible. If you sign up through the link in the video comments, you get an extra 20% fee discount, which can significantly reduce your fixed costs. With a 20% fee reduction, you get the same discount as a VIP level 2, which is why I recommend this exchange. Now that the stop loss criteria and trading environment are set, I'll find high probability spots and proceed with trading. As I mentioned earlier in the video, I've tried various trading setup concepts, but the only strategy that worked in the long run is the one I'm about to share. You don't necessarily have to follow my strategy. If you have your own method, you can just use your own strategy. The method I use involves utilizing the support and resistance of options. With options, you can easily and visually identify the moments when large amounts of capital enter. Prices where big money gathers are prime zones for action, so this method involves checking where the big money is through options and betting strategically. This might sound difficult to beginners just by listening, but it's a very simple method, so please give it a try. First, you need to know what an option is. You don't need to know it deeply, you just need to know what kind of product it is. To explain briefly, an option is a product where you trade the right to buy or sell an underlying asset at a predetermined price by a set expiration date. The main reason for trading options is risk hedging. You buy put options to reduce risk in a falling stock market, or buy call options to reduce the upside risk of a short futures position. Options aren't really for individual traders like us, they're for institutions or high capital entities. They manage positions based on portfolios and always hedge during the process, so massive positions accumulate in options. Since option positions belong to high capital entities, you can easily make a profit just by following these positions. Let me give you an example. Go to Deribit and check the open interest for Bitcoin options. The reason we use Deribit is that 90% of Bitcoin option trading volume is processed here. Click on Matrix Options and check which expiration date has the highest open interest. First, since the volume is highest on March 27th, let's look at the volume for the 27th. After switching, we check the max pain price level. Max pain refers to the range where the most option positions expire worthless. Since prices tend to converge toward the max pain level on expiration day, it's crucial to know this price. Identify the max pain and mark it on the chart. I'll mark it and label it as max pain. Returning to options, check the option chain in the top options tab. Check the implied volatility here. Implied volatility is located in the top right. A higher implied volatility value quantifies the expectation of how much the future price will move. There's a number in parentheses which represents the market maker's hedging range. Since there's a 70% chance of expiring within this range, we'll trade in this high probability zone. Add and subtract the implied volatility range from the current price. The number in parentheses is the implied volatility range. Mark the current price plus IV as resistance and the price minus IV as the support zone. Now, there's a 70% chance the price stays within this range until the 27th expiration. I plan to build long and short positions within this range to take profits. Next, we need to check the liquidity zones. Liquidity zones refer to areas where numerous limit orders and positions are concentrated. The reason these zones form is very simple. It's because many traders set their stop losses and liquidation prices at similar levels. Major players with large capital intentionally target these zones and move toward them. They need counter orders to absorb their volume, so they push prices there to trigger liquidations and fill their large orders easily. Thus, major liquidity zones are like bus stops that these big players must visit. A large liquidity zone has formed at 72,000, which could attract the price. I've entered the 72,000 liquidity price level on the chart. I've now marked both the options range and the liquidity zone on the chart. From now on, you can trade along these lines. Currently, it's stalled after being rejected once at the max pain line. Since the liquidity zone is below max pain, there's a high chance the price drops there. If the price touches the 75,000 range again, you can open a short position there. When opening a position, never forget the risk management rules. Invest only up to 20% of total assets, and if you lose over 2% of total capital, cut positions decisively. Finally, I'll show you a few posts from my Telegram channel where I predicted prices using options. On January 15th, I warned subscribers that an uptrend would be difficult and a sharp decline could occur. January 15th was this day, and the subsequent continuous decline triggered a massive wave of liquidations. Without options, this scenario would have been impossible to predict. Next is the date of December 22nd of last year. I posted at 10 AM Asia time, noting max pain was at 96k, spot buying was occurring for delta hedging, and I informed subscribers of the market rise. This was the chart situation at that time. The vertical line is the time of the post. As stated in the post, the market went up. Through options, we could know the price in advance. In the mid to long term, options are a great indicator of market direction, so beginners should focus on where the real money is placed rather than getting bogged down in indicators or chart-based concepts. You will be able to feel that this is a much faster way. This concludes the full guide on how beginners can make money with crypto trading. If you are unsure how to use the exchange, I have uploaded a video on how to use it on my YouTube channel. For beginners, watching this video as well will be of great help. I will organize the site links needed for trading in the video comments. If you need them, please click and check them out. Well then, I will say goodbye for now. Thank you.